All right, everybody, welcome. Thank you for joining me today. Today's program is Farm Business Analysis and Benchmarking. My name is Florencia Colella, and I'm a Farm Business Management Educator with Michigan State University Extension. My pronouns are she or they, and I am multiracial. I'm seeing Brenna's message. Hi, Precious. Yes, please stay muted, Brenna, and if you need to ask a question or something, you can unmute yourself. If I hear background noise, I'll mute you. So if there's anything you want to express during the webinar, including questions, you may type it in the chat box or unmute yourself and show your video if you prefer to do that. But please stay muted. I may have to mute you if there's background noise. Hi, Ron and Margie. So if there are any questions I'm unable to answer live, I'll send the answers in a follow-up email that you'll receive after the meeting. I am enabling, so just give me a second for that. Okay, I think I just enabled the automatic live transcription for our deaf or hard of hearing participants. This automatically adds text to the bottom of the video with a real-time automatic transcription. You can take a moment now to turn on or off the live automatic closed captions. If you're joining from a computer, you can do that by going to the CC Live Transcript button at the bottom of your Zoom window. On cell phones, settings are just a bit different, but you should be able to find them by going to your Zoom options. Hi, Roxanne. So I'd also like to acknowledge that Michigan State University occupies the ancestral, traditional, and contemporary lands of the Anishinaabe, Three Fires Confederacy of Ojibwe, Ordabwa, and Potawatomi peoples. In particular, the university resides on land ceded in the 1819 Treaty of Saginaw. We recognize, support, and advocate for the sovereignty of Michigan's 12 federally recognized Indian nations, for historic Indigenous communities in Michigan, for Indigenous individuals and communities who live here now, and for those who were forcibly removed from their homelands. By offering this land acknowledgement, we affirm Indigenous sovereignty and will work to hold Michigan State University more accountable to the needs of American Indian and Indigenous peoples. MSU Extension programs are open to everyone. We are required to ensure civil rights policy adherence to report program participant race and gender data to the United States Department of Agriculture. Providing this information as a participant is voluntary, but I would really appreciate it if you could take a minute to fill out this form. And just let me put it in the chat. It helps me show the reach of the work that I do. Individual responses are not shared with the USDA and are kept separate from registration and mailing lists. So maybe you can do that as we go through the program or afterwards. I'll put it in the follow-up email too. Okay. So if you came to the last session and completed the survey, thank you. But since this is a different session, you would have to do it again. Yeah, Ron and Margie, thanks for asking. Again, it's voluntary, so if you don't want to do it each time, it's okay. But if you could, that would be great. All right. Finally, I'd like to recognize that as adults trying to learn while riding the demands from farming and life in general, I hope we give each other as much grace and support as we can. Without further ado, let's get started. And we are first going to start with some background, especially for those that weren't here the past two sessions. So back in the first session of this series, we discussed record keeping. That is the art of managing an organization's financial information throughout its life cycle. We said that in order to achieve different goals, record keeping can be done at different levels, depending on the amount of information recorded. The minimum amount of information to be collected would be what's necessary to file income taxes. Then adding some more information, you can put together your cash flow statement and balance sheet, and that is what you'd need to get to the second level to access loans or other sources of financing. We reviewed both of these levels last time. The third and fourth levels are about decision-making or management at the whole farm level and adding even more information at the enterprise level. Before a farm can get to one level, they first need to master the previous ones. So today we're going to focus on record keeping for management or decision making at the whole farm and enterprise level. Neither tax forms nor the cash flow statement or the balance sheet give you a complete picture of the profitability of the farm. For this, you need an income statement. Once you have the whole package, a cash flow statement, beginning and ending balance sheets, and the income statement, you can make a whole farm financial analysis. And once you get there, then you can move on to the highest level of record keeping, level 4 or enterprising. Enterprising breaks up the whole farm pie into different production units. It provides very powerful information such as break-even points and profitability information for each crop, livestock species, or crop year. It is useful to set goals and identify strengths and weaknesses of the farm. The good news is that if you collected all of your tax information for level 1 and wrote your balance sheets for level 2, you already have all the information you need for level 3. So today, I'll show you how to use that information to make management decisions. Farming is special in the sense that we depend on the cash flow statement and the balance sheet to put together an income statement. Other types of businesses are not so reliant, especially on the balance sheet, for creating the income statement. This is because in farming, certain accounts will just not appear on your accounting system. Some asset and inventory accounts, like those for standing crops, feed and grain and storage, and livestock, will usually not be accounted for in the accounting system, but they are part of what the farm owns. And changes in those accounts from year to year have an impact on overall profitability. A simple example is, suppose that according to your 2020 and 2021 cash flow statements, you had a net income of $1,000 both years. But at the end of 2020, you had 200 pounds of crops harvested in storage, and at the end of 2021, you had 500 pounds. What year were you actually more profitable? 2021. The balance sheet gives us that inventory information to make that adjustment. Also, usually farmers will be in cash rather than accrual accounting systems, so they seldom keep track of things like accounts payable and receivable during the year. So if at the beginning of the year you owed $100 and at the end of the year you owed $500, was income the same? Or another example is prepaid expenses. This is stuff that you bought and paid for this year, but you didn't actually use to produce this year's crop. We want to make sure that we match the revenues and expenses with the production for the same accounting period to get a more accurate measure of your profitability. And the balance sheet allows us to collect all of that information once a year and have it available either for a meeting with a lender alone, or if we want to get more out of it, then to calculate profitability on an income statement. So the mechanics is what? We basically take the cash flow statement, or what is called a cash-based income statement, or it could even be tax records, wherever we can get all income and expenses for the farm, and make adjustments to it with information we get from the balance sheet. In doing this, we create what is called an accrual adjusted or true income statement that shows true farm production and profit. Note that we will actually need two balance sheets, a beginning and an ending balance sheet, because we're actually interested in the change in some of those balance sheet accounts, not necessarily the value. We will make adjustments for grain, feed, livestock, and standing crop inventory accounts, accounts receivable and prepaid expenses, machinery, vehicles, and buildings, and improvements, which are all asset accounts, and accounts payable and accrued expenses, which are liability accounts in the balance sheet. This figure shows a relationship between the balance sheet and the income statement over an accounting period of 1 year. At the beginning of the accounting period, you're going to create a balance sheet. Then at the end of the accounting year, you're also going to create a new updated balance sheet. Remember that each of these is going to show you at that particular point in time, what were your total assets, liabilities, and net worth. Contrast this to the income statement, which says, over this whole particular period only, what were my income, expenses, and resulting profit? So apart from showing profit for the current year, you can use a few income statements from a series of years to track the business's profitability over time. Have I had a pretty consistent profitability? Have I had years of high profitability and years of low profitability? Or have I had a string of low years? Multiple years of low net farm income can point to reasons that I might have cash flow problems, not be able to meet my financial obligations as they become due, or not be able to pay for my family living expenses. The income statement can also describe how your net worth has changed from one balance sheet to the next through the retained earnings section of the balance sheet that we discussed last time. So what is an income statement, also known as the profit and loss statement? It is a report that presents a summary of income and related expenses and computes the resultant profit or loss from operations for a given period, normally 1 year. And as with the other financial statements, it is important to clearly identify the people or the business entities being described by the statement. Sometimes you'll hear profit referred to as the bottom line. Net farm income is a very important number that's at the very bottom of the income statement. We are going to refer to what some people call profitability as net farm income. Net farm income is the amount by which gross revenue exceeds total expenses, including both cash and non-cash, like depreciation, and any gains or losses on the sale of large capital assets. Profit technically is different from farm income. It is net farm income minus opportunity costs. Opportunity cost is the amount an investor, you in this case, gains or misses out on when they commit to one investment choice over another. As a farmer, you probably don't write yourself a paycheck for your labor and management, or maybe you also have family labor that's unpaid. You have also invested equity into the business that you could have invested somewhere else. So the net farm income is the return that you get for these unpaid factors. And if you were to subtract these opportunity costs, then we could call net farm income pure economic profit. We will make estimations to account for this. This is one of the reasons we use both cost and market values in the balance sheet, like we discussed last time. So here's the basic structure or flow of the income statement. It starts with a gross cash income and total operating expenses. By subtracting them, it arrives at the net cash income. This value is what's subject to cash basis income taxes. The income statement then makes inventory adjustments to determine net operating profit, which includes adjustments for crops, feed and market livestock and inventory, growing crops, receivables, prepaid expenses, accounts payable and accrued expenses, hedging accounts, and breeding livestock. Next, depreciation and other capital adjustments are made to determine net farm income. This includes changes in machinery, equipment, vehicles, buildings, and improvements. If net farm income is positive, then we're going to say that the farm made a profit, and if it's negative, we're going to say that the farm incurred a loss. Okay, so let's dive a little further into those accrual adjustments. We want to match revenues and expenses to the actual production activities that took place during the accounting year. So for example, if you have inventory on your beginning balance sheet, is that production from this year? No, that would be production from the previous accounting year. So we do not want to count that. On the other hand, anything that we have in inventory at the end of the year would be considered this year production. Another example is a change in accounts payable. At the beginning of the year, if we have a balance in your accounts payable account, which is a liability account, this will be debts that we had from the previous year. We do not want to include these debts against our profitability this year. But at the end of the year, if there is a balance in the accounts payable account, these are funds that we owe to others from this year's production cycle. We want to account for these accounts payables as expenses this year. So for crops, feed and market livestock and inventory, receivables and other current assets and prepaid expenses and growing crops, we will calculate this as ending values minus beginning values. For accounts payable and accrued interest, we flip the calculation and we adjust them as beginning minus ending values instead of ending minus beginning. And some other assets may have purchases or sales. And for those, we will do ending values plus sales minus purchases minus beginning values. Examples of these are hedging accounts, other intermediate and long-term assets, breeding livestock, machinery, equipment, vehicles, and buildings and improvements. The Farm Records Book for Management is a free spreadsheet by Michigan State University Extension that can be used on the computer or printed to fill out by hand. A booklet can also be purchased at your local extension office or at the MSU Extension online store. The first couple of pages are really easy to fill out and are enough for tax filing, and it gets more advanced as you go through its different sections. Page 4 helps you write a cash flow statement, and page 8 has the balance sheet. And on pages 9 and 10, it gets into the nitty-gritty of the income statement and farm analysis. Okay, so next we will learn about farm business analysis or farm financial analysis. While looking at your set of farm financial statements, that's the cash flow statement, balance sheet, and income statement, is great, especially if you are able to do it over a series of years. Accurately monitoring your farm's performance entails more than that. Your farm does not exist in a vacuum, so you want to look at other farms, including top performers in your industry and average farms of about the same size. Looking at your financial information compared to standards will help you interpret your farm's situation and create an action plan with steps to improve the areas that need it. In order to be able to compare the relative financial condition of your business with others, or even with yourself over time, you need to use ratios. This is because business sizes vary, and ratios provide a standard metric independent of size. A large business and a small one may be very different in terms of dollar values on their financial statements, but ratios can indicate the relative degree of financial strength or weakness. The 5 main areas in a farm business analysis are liquidity, solvency, profitability, repayment capacity, and efficiency. We typically show the measures in a scorecard. It makes it easy to gauge if our farm is within the vulnerable, strong, or caution area for each of the measures. Liquidity represents whether a farm can pay off its immediate debt. Low liquidity will look like cash always being tight. If liquidity is low, the operation may need to refinance some debt, slow down expansion, sell some assets, lease instead of own ground, equipment, or buildings, reduce draws, or pay down loans. Liquidity ratios are the current ratio that tells us if we have enough current assets to cover our current liabilities, if we had to pay them off immediately, and the working capital to gross revenue ratio that tells us the operating capital available in the short term from within the business relative to its size to purchase inputs or other items after the sale of current assets and the payment of current liabilities. Solvency is the ability to pay long-term debt and represents a farm's ability to thrive in the long term. If solvency is low, you should retain more of the net farm income instead of reinvesting or drawing it out, or sell some assets to reduce debt. Solvency ratios are, well, actually, the only really important solvency ratio is the debt to asset ratio. This ratio tells us what percentage of assets are owed to creditors. It can be calculated as total debt to asset ratio or farm debt to asset ratio. The total debt to asset ratio tells us what percent of all your assets are actually the bank's, and the farm debt to asset ratio represents the percent of farm assets that are really the bank's. It measures the degree of risk exposure of the business and its ability to take risks. Liquidity and solvency ratios are calculated with information from the balance sheet. Profitability, repayment capacity, and efficiency ratios, on the other hand, draw information from the 3 coordinated financial statements: the balance sheet, the income statement, and the cash flow statement. I wish I could explain to you how to calculate each ratio, but that would take too long. The Farm Records book that I mentioned before walks you through the calculation of each of these ratios. You can use it to understand the theory behind these ratios, as well as doing the actual math for your own farm. It even provides more ratios than the ones presented here. Okay, but let's look at profitability. Profitability is generally the first area of concern, although it's not the most important one. It represents the difference between the value of goods produced and the cost of the resources used in their production. Low profitability may be a matter of lack of adequate resources and can sometimes be increased by adding more labor, management, or assets such as land, machinery, or livestock. So there's 4 main profitability ratios. The rate of return on farm assets, that represents the average interest rate being earned on all assets or capital invested on the farm, or in other words, how much profit is being generated in relation to the amount of assets employed by the business. And it's also known as the rate of return on investment or capital. On most farms and ranches, there is a mixture of creditors' and owners' investments or capital. Another important measure of profitability is the return on farm equity, the return or interest on the owner's share of the capital invested. Should the business be liquidated and the liabilities paid off, only the equity capital would be available for alternative investments. This return can be compared to returns available if your equity were invested somewhere else, such as a certificate of deposit. If the farm has no debt, the return on equity will be the same as the return on assets. Rate of return on farm equity in general should be higher than rate of return on assets. The operating profit margin measures the operating efficiency in terms of the return per dollar of sales. A higher value means that the business is making more profit per dollar of revenue. A low value can be caused by low production, low prices, high input costs, or operating expenses, or overall inefficient production. At 25%, operating profit margin ratio means that on average, for every dollar of revenue, 25 cents remained as profit after paying operating expenses, including owner's labor and management, that were used to generate that dollar in the first place. The asset turnover rate measures how efficiently assets are being utilized in the business to generate dollars of value-added production. You could think of it as capital productivity. The combination of the asset turnover rate and the operating profit margin ratio determines the overall profitability in the business. The asset turnover rate times the operating profit margin ratio gives you the rate of return on farm assets. So in order to improve the rate of return on assets, you either must have the same income with a lower investment, so improve your asset turnover rate, or make more profit on every dollar that you turn into the business, so improve your operating profit margin. So a low asset turnover rate can be improved by liquidating unproductive assets, including machinery, unproductive land, or high-value land, or increasing the value of farm production. A farm business that owns most of its assets, including land and facilities, will have a business that will have a relatively low asset turnover rate compared to a farm that rents most of its land and facilities. Okay, so next are repayment and capacity and repayment and replacement capacity ratios. Solvency and liquidity that we just saw have to do with longer and shorter term debt, but they don't give you, your lender, a good idea of whether you as a person are in a good position to pay debt and replace needed capital. That is why there are also repayment capacity measures. They represent your ability to replace assets while paying for business and personal obligations like debt, living expenses, and taxes using both farm and non-farm income. They are not measures of business performance alone, but of someone's borrowing ability. The term debt coverage ratio is the first one, and it measures the ability of the business to cover all intermediate and long-term debt payments using money left out from the cash generated by the farm after paying all bills. And the replacement margin measures the amount of income remaining after paying principal and interest on term loans and unfunded or cash capital purchases. Efficiency means if adequate resources are available, but profitability levels are still low, then it's probably an efficiency matter. Efficiency measures represent effects of management decisions on gross income. Poor efficiency is usually a result from either low efficiency in the use of assets, which may be solved with training, by using higher quality inputs, or by changing enterprises. It could be a result from low selling prices, which can be solved by using new marketing tools, checking new markets, or improving product quality. Or it could be a result of high costs. Costs can be lowered by switching suppliers, buying raw materials, and using older equipment. So the four efficiency ratios can be interpreted as an amount in cents of every dollar of revenue coming into the business that are either used to pay for the different types of expenses or remain as net income. They have to add up to 1 or 100%. So the operating expense ratio shows the proportion of farm income that is used to pay operating expenses, not including debt principal or interest payments. Farms with a high proportion of rented land and machinery or hired labor will tend to have higher operating expense ratios. The depreciation expense ratio indicates how fast the business wears out capital. It tells what proportion of farm income is needed to maintain the capital used by the business. A farm that has new facilities will experience a high depreciation ratio, but highly utilized facilities can keep the depreciation ratio under 10%. The only way to decrease the depreciation ratio without a major change in the business is to decrease the amount of capital purchases each year. A higher than average ratio may indicate underused capital assets. And conversely, a lower than average ratio may indicate that the farm frequently uses custom operations, that the machinery is old or perhaps too small, or that the farm has a lower investment in buildings or other improvements. The interest expense ratio is used to measure the interest expense compared to the gross income from the operation. It shows how much of the gross farm income is used to pay for interest on borrowed capital. A high interest expense ratio indicates that the business is not generating much income in relation to the amount of interest being paid and needs to reduce debt or increase the output with the investment that it has. High depreciation and high interest ratios often go together. If these two items are high, the operating expense ratio needs to be relatively low in order to have a satisfactory net farm income ratio. The net farm income ratio is the amount of money left after operating, depreciation, and interest expenses. It compares profit to gross farm income. It shows how much is left after all farm expenses, except for unpaid labor and management, are paid. A low net farm income ratio indicates the farm is not generating much profit for the unpaid labor or for net worth gain. Businesses that do not have any unpaid labor and where the owners are paid through salaries will tend to have lower farm income ratios because the value of labor is included in the cash expenses. The only difference between the operating profit margin ratio and this one is the value of unpaid family labor and management. Okay, so far, if you've put together your ratios, you'll end up with a scorecard like this one for your farm. It is important to note that if you are doing ratio analysis, you have to look at them all at once. This is because no one ratio can fully describe a farm's financial situation, just like the doctor will not look at just one aspect of your health when trying to diagnose. It is by looking at many different measures that we will understand a farm's financial picture. And like with the cash flow statement, balance sheet, and income statement, if you repeat these analyses every year, then you'd be able to track your performance changes in time, which can provide valuable insight. So a few slides back, we discussed that a complete business analysis entails looking at other farms, including top performers in your industry and average farms of about the same size. This is a process called benchmarking, and we'll now dive into it. Benchmarking is a process where a business owner can find out how they are performing against others in the same industry. This allows individual performance improvement, which in turn makes the whole industry better. Benchmarking is not a theoretical concept of best practices. It is about the whole range of real businesses that comprise an industry. Companies usually benchmark their financial performance, their products, or their processes. Today, we'll focus on financial performance benchmarking. There are 4 steps in benchmarking. The first one is to gain a general understanding of your business performance. It is very hard to benchmark unless you have data on your own business. The second step is selecting a reference company or set of companies, usually top, bottom, and average performing ones, and doing a general analysis of them. The third step is selecting a few key measures or aspects and comparing your business's metrics with theirs. If you select these metrics carefully, this comparison should provide useful information about your strengths and weaknesses. Lastly, once you have identified opportunities of improvement, you can lay out an action plan. So the first step is to understand your own business. And you've done a farm business. And if you have done a farm business analysis, you'd have a good handle on your farm's strengths and weaknesses. Another really useful tool for calculating financial ratios that I didn't tell you about before is the Help Me Calculate My Ratios section of FinBin. The website is finbin.umn.edu. Let me see if I can put that in the chat. Well, it's not linked, but if you copy it and paste it in your browser, you should be able to get there. So if you want, you could even calculate your financial ratios on paper or in a spreadsheet like the Farm Records Book for Management I mentioned before, but this will calculate your ratios for you. I have to say, though, that while I think doing the financial analysis by hand is a great exercise and you can totally do it, it's just complex. Attempting to do it alone may lead you to give up or wait until the situation at the farm calls for immediate action, which usually is the worst moment to make important decisions, or pay costly financial analyst fees. The option that we think is best is to use Michigan State University Farm Business Management educators. We are trained to use a software system called FinPack. The software is part of the same package as the webpage for calculating the ratios that I just showed you, called FinBin. You can probably see the similarity in the names there. You can buy a copy of the FinPack software yourself and do your analysis yourself. But if you have your tax information and can complete a balance sheet template, a Michigan State University Farm Business Management educator can analyze your business for you free of charge and then interpret the results with you. So as you know by now, a farm financial analysis will give you a ton of information on your farm's liquidity, which is the ability to meet financial obligations and pay for family living, your farm's solvency, which is the ability to pay long-term debts, the profitability, which is whether if you made money, the repayment capacity, which is the ability to repay debts on time using income, and efficiency, which is a reflection of the effects of your production, purchasing, pricing, financing, and marketing decisions on your gross income. On this slide, you can see all the financial ratios to the right with beginning and ending values for the ratios that come from the balance sheet only. So liquidity and solvency ratios have beginning and ending values. And there's also cost and market values for profitability and efficiency ratios. We look at cost values to measure the actual returns to investment in the business. And we discussed this a little bit last time. Market values measure the opportunity cost of investing assets in the business. So to know how much the money that you put into the farm is earning, look at the cost measures. To decide if more money should continue to be invested in the farm, look at the market measures. Comparisons across farms are more meaningful using market values, while comparisons from year to year of an individual farm are more meaningful using cost values. Profitability, repayment capacity, and efficiency ratio calculations draw from all the balance sheet, the income statement, and the cash flow statement. To the left of this screen, of this report, there is a summarized income statement with net farm income at the very bottom. And this report has a bunch of other pages with more detailed information on how they came up with these numbers. But this is an output from that FinPack software that I had told you about. So the second step of the process is finding some information about other companies. For that, all you have to do is visit the FinBin database again at finbin.umn.edu and go to the Generate Benchmark Report Whole Farm option to the left. By using the crop and livestock options that are just below, you can get production data, but we will just stay at this general report for today. At the main screen, you could filter by state, year, or type of farm, acreage, profitability level, and so forth. But we'll just go ahead and hit Generate Report. And this will give us the simplest farm financial measurements report possible. You will notice that it has the same ratios as the individual report that I showed you earlier. The difference is that this one includes median values for a bunch of farms included in the database. And then I'll explain what the percentages to the right are in a little bit. But let's look at what we can do with what we have so far. The first thing you can do is compare your farm's financial information, in this case to the left, with the group's information to the right. Once you've done that and have a general idea of the overall performance of your farm with respect to the group, then you can move on to the right portion of the table. Before that, though, if you feel like after analyzing this group of farms side by side with yours, comparisons really wouldn't be meaningful, then you can go back and generate a different report until you find a group of farms that are really comparable to yours. So while comparing our farm with the group median can be useful, it is more useful to use percentiles. Using your own values, you can mark on this table which percentiles you fall under for each metric. This tells you where to focus your attention. For this example, this farm should focus mainly on the efficiency aspect, which is where it falls on the lowest percentiles at the bottom. So now that we have determined that, we can read more about how to interpret all these metrics. The MSU Extension website has a great series of articles that explains ratios one by one in detail, and the Farm Records book also has explanations on each ratio as well. Once we've done all that, we can move on to the last step of the process, which is to identify ways to close performance gaps and lay out an improvement plan. An improvement plan has to be smart. It has to be specific, measurable, attainable, realistic, and timely. So make sure to apply those concepts to ensure your plan's success. Okay, so lastly, how to get involved with all of this. If you complete the financial analysis with an MSU Extension educator, you can not just look at other farms' information, but also contribute to the data set. This is a free public service, and any Michigan farm can participate, including crop producers, dairy producers, fruit and vegetable, and even value-added growers. Your participation is important because when not enough farms for an industry participate, then the database will not show good comparison information. The nice thing about participating is that the summary information that you get about your farm is perfectly comparable side by side against the database information. It is important to know that, as they say, garbage in, garbage out, though. So your fundamental cash and balance sheet records have to be right in order for this information to be meaningful. If you're struggling to put together those basic records, please consider the MSU Telfarm program. This is a paid service that gives you a standard chart of accounts for you to use, and they help you set up your accounting system. Using this chart of accounts makes it really easy to get the analysis done at the end of the year with assistance from a farm business management educator. And since many farms are enrolled in this program, all using the same standard chart of accounts, that ensures being able to benchmark them. The Telfarm program also will review your books and back them up throughout the year and do a year-end tax plan for you. So in summary, there's a database of farmers doing financial analysis that once you get a handle on your own numbers, you'll be able to compare yourself against. It is pretty neat to know where you stand with respect to everyone else out there. And it is even neater if you become part of the group that contributes to keeping the database relevant. The recommendation for a successful farm is that you do financial analysis once a year. So far, we've learned the steps to use your records for management purposes at the whole farm level. I'm sure you were glad to learn that all it will take is to collect tax and balance sheet data and pick up the phone and get working with your local extension educator. However, don't underestimate the challenge of collecting information and working with an external source. It will take some learning and trust building on both your part and the person you're working with. Okay, so now we can move on to enterprise analysis. As a reminder, this is the last and highest level of accounting after taxes, financing, and decision-making at the whole farm level. Before a farm can get to one level, they first need to master the previous ones. Remember that enterprises or profit centers can be individual crops or livestock species within the farm. It can also be different livestock production phases or crop years, farms or fields. It's literally any subcategory that you want to make it to be. One of the most powerful outputs of enterprise analysis is break-even points. Another advantage of keeping records at the enterprise level is that it will tell you which enterprises on the farm are profitable. This is important when deciding what crops to plant, livestock to raise, or if other market opportunities should be explored. It identifies strengths or weaknesses of the business. And another advantage is that it allows you to analyze crop years. A whole farm business analysis does not provide enough information to be able to tell which crop years were profitable or unprofitable, just what calendar years were. This is fine if you usually sell the crop in the same year you grow it or the following year. But once you start storing your crops and sales for different crop years start overlapping, you will start finding it difficult to tell which is which unless you do enterprising. This is more for row crop farmers that could store their crop for more than 1 year. Some of the disadvantages of enterprising are that it is time consuming because you have to allocate income and expenses to the different enterprises. And this can be difficult to do without a computerized system. It also requires some extra effort in setting up the system and learning the concepts. So what information do you need to collect in order to be able to do this type of analysis? You'll have to allocate all income and expenses to individual profit centers, including non-cash costs such as depreciation and management or unpaid labor. Some income and expense accounts will be easy to allocate and keep track of during the year, but some will be hard, like fuel. For those, it may be simpler to use a percent allocation at the end of the year. You will also have to allocate balance sheet items such as prepaid expenses, growing crops, livestock, machinery, and buildings. One of our colleagues talks about the word swag, which is scientific wild ass guess. And there's a lot of that going on for enterprising. It does not all have to be exact, but it has to be a good guess. Another piece of information you'll have to add to your record keeping system in order to make an enterprise analysis are quantities of purchase and sale items. The IRS does not care about quantities, just the dollar amount. You can even write a cash flow statement, income statement, and balance sheet and make a full farm financial analysis without even ever discussing amounts. But the only way to know if a profit increase came from better sales versus better prices is tracking quantities. And this is where this type of analysis comes in handy. Here I'm referring to production information like acreage and yield or number of cows milked and pounds of milk sold. A concept related to enterprise analysis are enterprise budgets. Enterprise budgets are estimates of your future income and expenses associated with different enterprises. The information from enterprise budgets is used to make decisions of changes to existing enterprises or potential new ones. As always, past information helps build a good budget, and a good budget helps inform and analyze enterprise performance after the fact. We also mentioned break-even points, so let's define that. Break-even is the point at which costs equal revenue. So a break-even point is the number of units of a product that must be sold to cover the fixed and variable costs for its production at a specific price point, or at what price a certain volume of product should be sold to cover its costs. They are useful for determining what type of marketing and what inputs to use. Break-even points can be calculated in different ways to achieve different goals. For example, knowing when you'll start covering costs, knowing how much you need to make or maintain, knowing how much you need to make to maintain net worth or increase net worth, or knowing how to meet cash flow demands, such as debt payment and machinery fleet maintenance. The math to calculate break-even points independently from the goal of the analysis is always cost divided by expected production gives you a break-even price, and cost divided by expected price will give you break-even production. You choose what costs to use depending on your goal. If you want to know when you'll start covering costs, use fixed and variable costs. Or if you want to know how much you need to make to maintain net worth, add money needed for debt, interest, and principal payments, family living expenses, and taxes to your fixed and variable costs. And if you want to know how much you need to make to meet cash flow demands, go one step further and add depreciation. And I mean economic, not tax depreciation, to all of the costs above. So in this section, we learned about the uses of record keeping for management at the enterprise level. We learned that enterprising is useful for finding break-even points and profitability information at the individual enterprise level, and that we need to allocate all income and expense and balance sheet items to the different enterprises and track quantities of inputs and products to be able to achieve this level. So it's a lot of information. Understanding how to perform and interpret farm financial analysis is a useful tool to analyze your farm's performance and plan for the future. Doing this type of analysis, though, takes a lot of time and effort, and you will not be alone when you decide to go ahead and do this for your farm. An MSU Farm Business Management educator can help do this analysis annually with you. That way you can focus on farming. That is what you love best. So that is the end of the presentation, and I have a pledge there to fill out the feedback survey. So I'm going to copy that link in the chat. And I have a couple other links that I'm going to put in the chat in case you want to take a look at them. One is for the farm records book. Then there's the store where you can buy the farm records book online if you want that. Then there's all right. Hopefully those are all linked. Yeah. So yeah, there's a couple of articles there about everything we talked about today, from accrual adjustments to farm financial ratios and measurements. Are there any questions? Ron or Margie, I'm seeing your question here. I don't know what CES stands for. Oh, cooperative extension. Yeah. Yep. I don't know if extension is called cooperative extension technically anymore. I heard that that term was dropped a while back. I don't know why, but so I don't know, actually, I think would be the true answer to your question. But we are extension. We are a land grant university, so I don't know. We are you in the United States or you're in Canada? Uh-huh. Okay, yeah, now I remember. Yeah, I think they dropped the term cooperative extension, but yeah, we are what used to be cooperative extension, and we still are cooperative, just without the term in the name. Okay, all right. I will just give you all 10 minutes back if you don't have any questions. If you want to stay and you want to look at how to calculate the financial ratios, I would love to walk you through, but it's just a lot. 10 minutes wouldn't have been enough to actually show you how to calculate each ratio. And yeah, thanks Marcellus for your comment. The book walks you through how to calculate each of them, so you have it there. So hopefully that's helpful. All right. Yep, I don't see any more questions here, so thank you for coming, and we'll see you next time.